When we are high school seniors, a lot of us have the dream of going to college. If our parents cannot help financially or scholarship funds do not cover everything, many of us resort to student loans to make up the difference. Fast forward to graduation and the job, whether it our dream or working towards our dream job, these loans become due. Many times, we are not making the salary or are attending graduate school, we put the loan debt in deferment or forbearance believing that someday we will be able to pay them. Life happens and we decide to purchase a home, but we now have a large student loan balance that is making it difficult to purchase. Sound familiar? Let me give you some practical advice based upon mortgage guidelines to be successful in purchasing your home. There is a debt-to-income ratio, depending upon which program that buyer selects, that the underwriter must adhere to for the loan to be approved. This is determined by taking your gross annual salary and dividing by 12. The first ratio is housing expense, and that percentage can range from 5% to 34%. The back-end ratio includes house and all debts listed on the credit bureau report, tax liens and child support, etc. This ratio can be as high as 55% with compensating factors such as assets and high credit scores. There are 4 programs that most buyers use when purchasing a home: conventional, FHA, VA, and USDA. I am going to break down the guidelines so that you have the necessary paperwork to make this as stress-free as possible. To qualify for a conventional mortgage, the minimum credit score for most lenders is a 640. The husband and wife team known as Fannie Mae and Freddie Mac each have their own guidelines as it relates to student loans. Fannie states that we can use the Income-Driven Payment Plan (IDR), or if the loans are in deferment or forbearance, we must use 1% of the outstanding loan balance or a fully amortizing payment using the documented loan terms. Freddie states that we can use 0.5% of the currently monthly payment or 1% of the outstanding loan balance or a fully amortizing payment using the documented loan terms. To qualify for FHA or USDA, most lenders today require the borrower to have a minimum credit score of 620. Both FHA and USDA do not give us any alternative other than to use 1% of the outstanding principal balance showing on the credit bureau report. To qualify for a VA mortgage today, most lenders require a minimum credit score of 620. VA will allow us to take 5% of the outstanding principal balance and divide by 12 to get a qualifying payment. Let's see an example of how the payment qualification differs amongst the programs. Jane borrower has a student loan balance of $150,000. She wants to purchase a home and has a credit score of 650. She applied for an income-driven payment plan and is currently paying $350 a month per the plan. On her credit bureau, her current payment is showing $1,000 per month. Since she qualifies for all programs, under Fannie Mae her payment would be $350. She has the documentation which can be submitted to underwriting for review. If she wanted to do Freddie, her qualifying payment would be $500 since her payment on the credit bureau is showing $1,000. On FHA and USDA, we would have to use $1,500 since they require 1% of the principal loan balance to be used as the qualifying payment. If Jane was a vet, her monthly would be $625 because we are taking 5% of the balance and dividing by 12. Finally, the most important factor about the income-driven plan is that it must be in effect for 12 months after the loan closes, which means if you are less than 12 months, you will need to get a new plan or an extension to make sure that you meet the 12-month requirement. In conclusion, you can buy a home. Planning is the key.